a panel discussion on minimizing the risk of economic value transfer in legacy contracts. So as you know, the transition away from JIBA over to Zaronia of existing contracts should be economically neutral, so that so the panel will be discussing that among other things, as well as the regulatory measures that may be necessary to facilitate tough legacy contracts. So for that discussion, it will be moderated by Zakhele Geninda. So we welcome you back to the stage alongside your panelists.
To the middle. Wind.
All right, how are you?
I like windows.
I feel like I'm in the middle here.
Yeah.
Good afternoon. Good afternoon. I'm glad to see that the room is still
Just hand
quite
this
full.
over. Yeah.
Clearly,
Yeah.
you must be getting some value from these discussions that we've had. I particularly enjoyed the two presentations from the group treasurers, and it fits in well with what we're going to discuss now. This is the biggest panel that we've got. Maybe it's due to the nature of the issue that we'll be discussing. And I'm hoping that this time around you'll engage and ask questions, unlike my first panel. Sure. So let me just introduce the panel members. Next to me is Ahmed from Standard Bank. He's a quantitative analyst. He's part of the credit adjustment spread, the swear word for today. And he is also part of the transition and coordination work stream. Next to him is Kanyisa. She heads the tax division at S&G Grant Thornton. She works with Kumar, whom we introduced earlier on as the chairperson of the accounting and tax work stream. And then you have Ngozi next to her, who is a senior manager responsible for market integrity at the FSCA. He played a lead role in the governance and regulatory issues work stream. And then we have Mosidi, who is a lead in the legal services department at the South African Reserve Bank, but she's also the lead person in the legal work stream of the MPG. I see, Mosidi, that the chair is back. I don't know if you want to swap seats or no?
Happy
Okay.
to.
Happy to continue. And then we finally have Stephen Breslin, who is an associate director for transfer pricing at Deloitte. He is also part of the accounting and tax work stream. And so I'll start with you, Ahmed, and maybe revisit this issue of credit adjustment spread. Clearly, it must be important that the MPG, it does provide some sort of guidance around this, or a recommendation in terms of how this credit adjustment spread has been calculated. We know that many jurisdictions have already adopted the EASDA approach, which is a simple historical mean looking at past realizations of, I think it's about 5 years. Why is then this issue of credit adjustment spread so topical for our market, and how is then the MPG thinking about it?
Thanks. Well, to start off with, JIBA is a term rate, and so there's already an embedded credit component in addition to other factors. Zaronia being an overnight rate and as close to risk-free as theoretically possible means we have a fundamental disconnect, and so it's extracting the credit component from JIBA and then overlaying this with Zaronia so that we can have a seamless transition for financial contracts referencing JIBA as we move past the cessation date. So it's really extracting that credit component from JIBA that is quite important because it affects all the derivatives that we look at going forward.
So we do have Zaronia, and we do have, now we do also have the proxy rate that we showed the guys, so we do have sufficient history, and I suppose, obviously, we have sufficient history for Java as well, so we should be able to replicate the Easter methodology, and maybe we move with that. Why aren't we just doing that then? We circulated a discussion paper earlier today to work participants whereby your working group has put, I don't know, 20-odd pages looking at other methods of calculating this thing.
Well, I suppose that ties into the fact that we have proxy data from 2016 for Zaronia, whereas it only officially started publishing in 2022. So even if we take 2025 December as the cutoff date, there still will be a period by which we are using proxy data to compute the credit adjustment or fallback spread. And so we looked at larger windows in which the fallback spread is calculated, as well as shorter windows, just to get a feel for how much that credit adjustment spread can vary and how stable is it as we move along in time. But if the goal is that the majority of the market participants sign up to the ESA fallback protocol, then we are limited to a 5-year window, and I think what's left to decide is whether we go with a mean or a median approach. But if we look at SOFR and LIBOR, the median was selected as the metric that gets used to compute the fallback spread.
Okay, and maybe finally, did you mention that in thinking about this credit adjustment spread, some market participants have voiced that the introduction of the new MPIF or new monetary policy implementation framework, whereby we use the surplus system to implement monetary policy, has had an impact on the behavior of JIBA, such that what you used to get before vis-a-vis what you get after the MPIF was implemented, it's no longer the same.
Yes, definitely. So with the introduction of MPIF, what we can, broadly speaking, say is that funding spreads for various tenors, short-dated and long-dated, that basis has tightened. And if we, again, this was also introduced in 2022, and if we take December 25 as the cutoff date, then we will have a large portion for a 5-year look-back period anyway, by which MPIF is going to impact the gas. And ultimately, because of the structural change from a liquidity shortage to a surplus, we anticipate a lower cash number as being a byproduct of that paradigm shift. Okay.
Maybe Mosidi, AJ mentioned that the ESDA protocol would give market makers the confidence to assume risk and facilitate trading. However, it was critical that we resolve this issue of the credit adjustment spread before we can finalize and make a recommendation to ESDA. And it was also mentioned that Zaronia has been included in the ESDA interest rate definitions for 2021. What do these two things actually achieve? And what do they mean, and why is it so important that we finalize the issue of the credit adjustment spread?
Okay. I think as a starting point, we've had conversation today and we've heard references of how large our derivative market is and around the Zaronia First initiative, and that, you know, obviously we would encourage as the central bank for the derivative industry to take up our new rate Zaronia. And in order to do that, counterparties are encouraged to start including contractual fallback provisions in their contracts. So what these fallback provisions do is that they allow for an adjusted rate. As mentioned by Ahmed, there's a difference between how Zoronia performs versus how JIBAR performs. They allow for that adjusted rate to be set and agreed by the market so that everybody's comfortable to move forward. So how that was done is that we started off by drafting a definition of Zoronia so that people understand what Zoronia is, when it's published, when it's fixed, and including that in the ISDA definitions. So by including Zoronia in the ISDA definitions, we did that as of last year, as of 2023. You can now apply Zoronia to a new transaction, and that would apply the fallbacks to your new transactions. But then what happens to the old transactions, right? Your legacy transactions, or your transactions that you had before we drafted this definition. That's where the protocol comes in. So what the protocol does is that it allows you to incorporate the same adjusted fallback to your legacy transactions. And how that was done in other markets was by means of a protocol, which is a mechanism that allows large numbers of contracts to be amended simultaneously by means of adhering parties voluntarily signing up to that protocol, understanding how that calculation looks, if it follows the ISDA methodology that is, and allowing that calculation methodology to be input in all the contracts. So the definitions that we updated, you mentioned, were the 2021 definitions. Those are the latest interest rate definitions that cater for interest rate products. Those are the ones that are endorsed by ISDA. Prior to that, what was being used was the 2006 definitions. But as I said, ISDA's now endorsed the 2021 definitions as the latest form of definitions that need to be applied. And if you forget everything that I say today, I think the most important thing from a timeline perspective to think about is 3 important dates. So we had 2020, when your international market was starting to, really think of fallbacks and, including SONIA and SOFA into the ISDA documents. At that time, a supplement was published by ISDA known as Supplement 70. And what that did is that it updated the 2006 definitions, which are the predecessor to the ones that are being used now. That updated those definitions to include the fallbacks for SONIA and SOFA. And then the next most important date is 2023. It's 2021. So from about mid-2021 until the end of 2021, ISDA decided that actually those 2006 definitions don't really work so well. The market is moving. There's a whole industry effort to reform reference rates. So they overhauled their definitions, and they came up with the 2021 definitions, which are the ones being used now. And they came up with a protocol system to those definitions, which is actually quite a nice system, because what it does is that it creates a module for each reference rate that you need a protocol for. So instead of going and amending the whole protocol for our region, for example, for South Africa, when we've reached the point where we decide that now we're ready for our protocol, then we would have a module onto the 2021 definitions for our own market, which applies the fallback for our own market. And the last date, as I mentioned, was last year, 2023, when we incorporated our own Zoronia into the 2021 definitions and allowed that to be traded on new trades. So essentially what that means is, because we can now trade Zoronia on new trades, and we're not yet at the protocol place yet for legacy trades, why are we there and what needs to happen for us to get there, right? Where we are is that ISDA has a very specific methodology that they use. They actually went through an extensive consultation process globally where they reached that methodology, which is the 5-year historic look back of the new rate, the risk-free rate, plus a spread. And that spread needs to be determined by our market, right? And that spread is published from an ISDA perspective by a specific service provider, which should then show indicative dates using that methodology up until the day where we issue a formal announcement to say, now this is the last day of a cessation event, essentially, which was a public announcement of the final date, and then that spread would fix on that date. So that calculation methodology needs to be confirmed by us as a market to say we're comfortable with that 5-year look back, with the spread fixing in that methodology and the fallback rate being calculated in that way. Once we've done that, then I think the drafting process of getting the protocol drafted will be quite quick, and we'll have a module for our region that will allow us to do that bulk recontracting of legacy contracts.
All right. That's pretty helpful. And you're saying that then ISA is waiting for us to indicate what methodology that we are comfortable with for this to happen. I mean, I would like to invite maybe others on the floor, because I think the major issue is that maybe we are not necessarily convinced that the current methodology, which is used globally, satisfies the conditions, or the peculiar things in our market. And so, because we can easily replicate that ISDA methodology and calculate the historical mean, and yet we are still thinking about this thing. What is it then that it would take for us to finish this work and make that recommendation as an MPG, and so that we can move away from this credit adjustment spread issue?
Is that question directed at me?
You can start, but I will open it up to the MPG members as well.
So my understanding from a legal perspective is that, difference between a median and a mean of the 5-year look back and what that means for the numbers. So, and obviously this methodology that they use work for the derivatives market. Can the same methodology or thinking work for the cash market is another consideration. So what the work stream is doing is putting all the industry participants, not just the derivative market members, but also the cash work stream, just to unpack what these numbers look like and make the call on whether it works for our market. That's as far as I can say as a lawyer. I'll leave it to the numbers people.
That is fine. Okay. Maybe I can come to you, Nkosi, then, on this issue of tough legacy contracts. And I think Richard mentioned that you may have retail contracts and you have thousands and thousands and thousands of those that you cannot, to your best ability, renegotiate, and you need to find a way of resolving those when JIBA is discontinued. And so those could potentially be classified as tough legacy contracts, and it does not have to be, I suppose, retail loans or retail mortgages for that matter. It can be any other contract. How can an organization identify a tough legacy contract vis-a-vis a normal legacy contract that they should either include fallback or actively transition out of? And how will these tough legacy contracts be treated?
Yep, so thank you, Zakele. Yeah, so you're absolutely correct. The issue around tough legacy contract was one that was discussed extensively today. I think the one important thing that was mentioned was the volume or the rand amount of the contracts that still reference JIBA to be in excess of 57 trillion. That's a lot. So I think I work better with pictures and diagrams, and I think and numbers. So I thought maybe it would be best to illustrate this point using a diagram in terms of what tough legacy contracts would be. So the point of departure here is the JIBA cessation date, right? So I mean, then you would have contracts that you would on your external, your right there, you would have contracts that you would come in place after the JIBA cessation date, right? You know, so those really don't have much issues because they should not be referencing, you know, JIBA in them. You know, they should be referencing, you know, the new reference rates. You know, and then you have also on the extreme left, which would have been, or which would be contracts that would be entered into pre the JIBA cessation date, right? And in this area, you've essentially got two areas, right, which are existing contracts, you know, and they'll expire before the cessation date. So even in this instance, you know, it's an ideal situation because then, you know, there wouldn't be any tough legacy issues because by the time JIBA ceases to be in place, the contract would have expired. Now, the issue becomes when we've got existing contracts that expire after the JIBA cessation date, right? And in that instance, how you then, or the thinking that needs to be applied is whether there is an adequate fallback clause or fallback provision for these contracts, right? And if an entity finds that there is, you know, an adequate fallback provision, you know, of some sort, then it means that after the JIBA cessation date, you know, that fallback provision or fallback requirements would come in play. But now the issue becomes where you find yourself in a situation where you would not have a fallback provision in the contract, or the fallback provision is inappropriate in the sense that it still refers to, you know, some form of, you know, a rate that would be sought to be discontinued, you know. So that's now the area where you don't find, or an entity would not find itself wanting to be in, you know, because now in this spectrum, this is where we'll be dealing with tough legacy contracts that would need to be transitioned, right? So essentially what you want there is and I think it was mentioned also earlier on, to say these contracts, as much as possible, you should try and seek to renegotiate, right? So that by the time, you know, JIBA ceases, then you would have them transitioned essentially. Yeah, and to the extent possible, Zakhele, and because of the issues that we have been informed, you know, I mean, through the work of the MPG as problem areas, and I think you can maybe move to the next slide. So yeah, so when we did the work on the MPG, looking into this issue of, you know, tough legacy contracts and what should happen in that space, the one thing we seek to actually ascertain from the market was the challenges that were being experienced regarding these tough legacy contracts. And we were pointed to these issues here. I've just listed a few, but there were significant other issues, or many other issues that were pointed out. You know, the first issue being the volumes of the contracts. You know, respondents saying to us, or the market saying to us, you know, we've got tons and tons of these contracts in place here that we would need to transition, right? And also, I mean, having to obtain consent, right, for changing the rate in this contract, in these contracts. And I think we were just now alerted to the fact of a contract that still references LIBOR. So I think then you will understand how this can be a challenge, you know, in terms of changing the rate, right? And which speaks to the next point also about the disagreement regarding the new rate, which respondents really were saying to us that, you know, there would be challenges there if they were to change a reference rate and to agree, you know, on the new rates that should be referenced, you know. And I think the one issue that you also mentioned regarding retail contracts, right? And in that space, we found that there was a lot of retail loans or loan agreements, you know, that reference JIBA, right? And that retail market, and it being subject to, you know, legal requirements such as the, you know, Consumer Protection Act and the National Credit Act, you know, that once you are in that space, you know, there's very limited things that you can do, you know, regarding, you know, the changing of the rate. So you would need to then make sure that you comply with the provisions of those acts, you know, just so that we maintain the spirit of the law, right? I think the other issue then was the complexities around, you know, contracts, having contracts that, you know, reference other contracts, you know, and those contracts being linked, you know. So I think in dealing with these challenges, and that's a matter that I'll speak to later on. I think first and foremost, the ideal situation is that in an event where you are able to renew, or an entity is able to negotiate a contract that it is currently in, that references JIBA, that should be our first priority. But I think being aware that there might be a situation, or there might be situations where issues around volumes and issues around consent and issues around consumer protection being relevant, there might need to be the involvement of the regulators in terms of looking at regulatory measures that can be taken or put in place in terms of looking to transition these tough legacy contracts. And I think that's an element that we will speak to later on. But yeah, in essence, that's it. Yeah, thanks.
Okay. We would need to get back to that one so that we can also understand what this safe harbor provisions that everyone keeps on talking about really are. But maybe before we do that, whilst we're still on this credit adjustment spread, if you have a synthetic JIBA rate that is used in a tough legacy contract situation, or you're going to have a replacement rate that includes a credit adjustment spread, you are still going to have some sort of value transfer. And that might have implications potentially from a tax perspective. So I just want to bring in Khanyisa and Stephen to just opine, maybe Stephen on an international tax perspective and Khanyisa domestically. What does this mean? Will there be capital tax implications? How do you deal with cross-border transactions and the likes? Maybe we can start with you, Khanyisa, and then we'll move on to Stephen.
Yeah, so from a local tax perspective, if taxpayers, I'll refer to the corporates that will be affected as taxpayers, if taxpayers, when the rate changes and they renegotiate the contracts, the only thing that change is the actual interest rate, then one should not expect any other implications. So I think when the group first met and we're looking at the potential tax implications of the change in the reference rate, I think everyone said there should be no tax implications. But when you look closer, and I mean, tax legislation would be formulated based on, or National Treasury, they would do it based on how they think people would act. But then every time we have annual changes in legislation, because then it changes to accommodate how people actually act. So on the version where people just change, you only update the rate, then there are no implications. On the version where some people decide first on an old contract to not only change the rate and look at other areas as well and update, then you may need to say, have you in fact exited the original contract and now entered into a new contract, which would mean you have sold whatever right or instrument that was linked to the old contract. Then you may have CGT or then tax implications because you have triggered a tax event. Then the other part may be if you change the contract and you introduce additional charges. So, I mean, if it's from an interest calculation, that would be easy because it's easily dealt within the interest that is deductible or taxable from a tax perspective, because there's a whole formula that would say you look at all your inflows and your outflows, so then that can be taken into account there. But if you're looking at other instruments like your lease payments, if you change a contract that is a lease and you have additional payments, that currently isn't covered in our legislation. So then one may need to either provide guidance and say, if you change, just list a whole type of contracts that can be affected, I would think, and then say, if you make changes beyond just linking the rate to, changing the reference rate, then these are the tax implications that one would need to, or this is how you should account for the possible tax implications. I think from a banking sector perspective, a lot of the tax is already linked to your IFRS. So however you are treating the change from From an IFRS perspective, then tax would follow that. So a lot more work would then need to be done from a model perspective and assessing on the derivatives if there are any extensive changes, if those changes result in those contracts ceasing to exist and then entering into a new one. So I think that is the tax position, at least in my view, at this point.
Yeah.
Please go ahead,
Just from
Kevin.
my perspective, as you can see, I'm hiding away because tax people are not really very welcome to any events. So I'm just hiding behind the podium. But looking at it from a transfer pricing perspective, because everybody asks me, you know, what's going to happen, specifically the banks that deal with interest rates. And what we've seen is that a lot of South African banks are providing a lot of their branches and subsidiaries in Africa loans in terms of tier 1 capital, tier 2 capital, and a lot of the loans are priced in JIBAR. What's happened from a transfer pricing point of view is we're looking at what actually happened during the LIBOR transition. What were the guidance from the OECD guidelines that states how do we treat this? Are there any issues? Now, the most important thing from a transfer pricing point of view is you can't have a winner and a loser. The original contract and the benefits of the contract have to remain the same. Because if there was any change in the value benefits, then you'd have a lender earning more and the counterparty, who's the borrower in another country, paying more. And then the tax authorities are going to say, hey, we're not going to give you that deduction because why are you paying more for an original loan? So what we try to strive for in transfer pricing is to smooth it out. Even though you have the transition, we're trying to support in the transfer pricing documentation and the policy that despite the fact that there's been only a pricing change, the economic reality hasn't changed. So there's no winners and losers. What we've also seen in terms of accounting is that we've seen that our accounting specialists have also followed the IBOR reform, and they have hooked on to 2 phases, which was initially proposed by the International Accounting Statements Board. And they looked at 2 issues. They looked at your pre-replacement phase and your replacement phase. So the pre-one was before you actually doing the transition, what you actually need to do from an accounting perspective. And that phase was specifically for hedge accounting, and they provided exemptions to the extent that you can still hedge the same item. You can still hedge the same item to the extent it is in relation to your reference reform rate. If there's any other changes, then you need to do a whole change in classification. So they give you that type of benefit, so there's no actual immediate changes to the hedge accounting. You can still carry on with the same item, but obviously you need to disclose the change in the item, the interest rate, and the risk on it. Then there was another area that was dealt with is the replacement during the period where you actually have the transition. And IFRS 9 has quite a large requirement when you do changes. So what they said, during a reference rate reform, they said that they give you a practical expedience type of process where you can actually do the changes in a more faster and less administrative type of process, but that's only in the event that you are making the change for a reference reform rate and there's no economic shift, meaning the value is still the same as it was in the other contracts. So I'll give you an example. If you have a contract, a lender and a borrower, and and in the contract it stipulates that the rate is based on a 3-month JIBAR +2, that's fine. When you go and you transition, we know that there's going to be a slight difference between the JIBAR and the Zaronia because of the credit and liquidity risk. So you have to add that little spread to equal the JIBAR and Zaronia, but the 2% spread that you had originally never changes, because that's purely based on the credit risk of the borrower. Now, if you go and you change the rate from JIBAR to Zaronia, and you change the credit risk of the borrower because he's deteriorated, then you don't get this practical expedience benefit. So one has got to take that into account for accounting. So I just wanted to show you from a transfer pricing that nothing has got to change. It's got to carry on the same way, and then from an accounting perspective. And then there was one more thing that we looked at, and this is also from a legal perspective. What happens when you have a change in a rate? What does it actually do to a contract from a transfer pricing perspective, and what does the OECD guidelines say into it? They say if there is a pricing change, it doesn't result in any restructuring or any closure and renewal, basically, of a loan. So therefore, there shouldn't be, as Kanisa said, there shouldn't be any capital gains issues. What it means is, it's just the pricing of the loan, it's a section within the whole contract, and all you're doing is doing the pricing. So there's no major tax effect on that. Okay.
Now I remember why I did so badly in tax at school. I thought we're talking about tax implications, but there you are talking about hedge accounting. I'm beautifully confused. But let's open it up to the audience in case there are some questions at this stage. We are running out of time, so we're going to wrap it up quite soon. Equally confused. You're allowed. Let me maybe close it with you, Nkosi. Then Zafa mentioned that this safe harbor provisions could potentially derail the JIBAR transition. Can you maybe just enlighten us in terms of what are the safe harbor provisions, why are they so necessary, and why they could be problematic in our case?
Yeah, so I think safe harbor provisions intend to do a number of things. So the one thing is that there will be a change in the reference rate, right? And that change in the reference rate impacts a particular contract, right? So, in other instances, or in many instances, and I'll just pick maybe the most obvious one or the most prevalent one for us, was when you looked at the NCR. So in terms of the NCR, there cannot be a unilateral change in the interest rate that references any of the contracts that is governed by the NCR, right? So now, if you introduce safe harbor legislation, you would introduce legislation that intends to essentially effect that change in the rate. So, and also, given that, a number of contracts will not be, able to transition, you might want to use what we call a synthetic JIBAR, right? So you also need safe harbor legislation that will speak to that, the publication of that synthetic JIBAR, and I mean, in the publication of the synthetic JIBAR, there might be, liability that arises because of that, So the other intention is for the safe harbor legislation to essentially speak to that liability, and protect, the publisher of the JIBAR for the liability that may arise as a result of the publication of the synthetic JIBAR or the use of the synthetic JIBAR, So I think in broad terms, safe harbor legislations speak to those, they enable a unilateral change, in the rate, from one rate to the other, in the event that, for instance, in this case, JIBA ceases to be used, So one party to the contract would be protected if they were to change the rate. And even in the new rate that is being used, and I'm just speaking generally here, in the new rate that is being used, the issues around the liability, in terms of implementing that rate in a contract, those are the issues that would be covered in these safe harbor legislations. So maybe just to speak further, when we considered, what the safe harbor laws should provide for, we also looked into what was happening, internationally in terms of, we all know that there was the Libel Act, that was enacted, and essentially that Libel Act also contains, these safe harbor provisions, So I think we would, the recommendation, or at least the considerations from the governance perspective was that, governance working group perspective was that, we should also take the learnings, from that process and how that, how those amendments, or what was included in the Libel amendments, but obviously ensuring that we actually localize them to our markets, to account for circumstances that exist within South Africa. But I think essentially, Zakele, safe harbor legislations provide for those things. Yeah.
All right. Thank you so much. I just thought of something important because it was asked earlier on for you, Mosidi, around LMA and the work that they've done, and you kind of mentioned that there's been some progress, in particular for cash markets. Do you want to maybe just quickly, just give an overview?
Okay, yeah, I'll be quick. So when the whole transition process started, as the MPG and the legal work stream, what we did is we were aware that there will be challenges when it comes to contracts and how people start to approach, the transition of those contracts. So we published very high-level guidance language, which was a sample clause on the replacement of JIBA. So it didn't really cater for, fallbacks. It was a bilateral, very simplistic clause, which was soft language that pulled the parties around the contract to, negotiate the terms of the nuances more once there was that transition. So the LMA then stepped in later last year, and consulted with their members locally, and also leveraged off their experience in the UK and in the US to, formulate that clause in such a manner that it fits into the South African law templates for syndicated lending, and that it still caters for, it's still a replacement of screen rate clause, so it calls parties to negotiate further, but it was more advanced, and it was waiting on the conventions to be formulated so that it can be bolstered into a full agreement that created a hardwired switch. So no longer we meet around the table and negotiate more later, but we have a hardwired switch. So what's happened this year, and what the LMA was educating the market on, is that they've now published a rate switch agreement, which is an exposure draft. So that means that the market must actually, those of you that are LMA members, please go onto the LMA website, download that agreement and look at it and see whether it works for a hard switch from JIBA to Zoronia. And if not, what are the challenges that you're seeing in the agreement? And those that aren't members, please do reach out to your law firms or your banks, ask about this agreement, what it caters for, so that we can all as a market engage on that agreement and provide feedback, so that we can have sort of consensus as a market around what that hardwired switch needs to look like. The benefit of the latest version is that it incorporates the market conventions that were published earlier this year. So the credit adjustment spread, hasn't been settled yet, but it does have a methodology there, or a definition that's quite standardized, that was used globally, that the LMA feels, should require minimal adjustments. Please don't come at me for this. I put a disclaimer there. So the thinking is that those agreements can start to at least be discussed and canvassed around the market to see whether they can be used. We would encourage, as the SARB and the MPG, for the use of those agreements to start at least in the loan space and the cash space.
Just
Thanks for
as you are consulting your lawyers about the change in contracts, you must bear in mind, if the initial expenses related to that contract were denied deduction from a tax perspective, the legal fees associated as well with the redrafting of the contracts will equally follow the same treatment. They won't be allowed deduction. So if you're paying too much, you can't claim the tax expense.
Can you submit it when I said brief
Can you
overview? She wanted
the
to add
lawyers
some
on our
more.
Giving tax advice on the stage.
But anyway, thank you so much. We actually have run out of time. The tax and accounting work stream has been reconstituted. So these issues of transfer pricing and also disclosure requirements and reporting hedge accounting, we will release, I hope, some guidance on those things in the near future. But you are obviously welcome to speak to Stephen and Kanyisa over coffee. For the derivatives technical session, it's going to start almost immediately. So we would ask you to grab your coffee and just go to the room that is directly opposite. They will be discussing non-linear derivatives, and part of that would be the work that they've done in coining the market conventions for non-linear derivatives. The rest of us, we can maybe just enjoy the coffee break for a little bit, and then the MC will call us in for the last session for today.
Okay.
Thank you.
Fantastic.
Thank you.
Lovely to see
you very
you
much, Nicola.
again. I saw you last year.